Taiwan Semiconductor manufacturing. Oh, semiconductors are great. Let me just go buy a semiconductor company. Guys, I love high margin businesses. Love it. Love it. Awesome. Very low debt company. Taiwan Semiconductor has come off its lows and got a lot of attention because our good friend Warren Buffett at Berkshire Hathaway has bought some. Now, keep in mind, I don't know if it was Warren himself. Remember that. A lot of times, there's a lot of purchases made at Berkshire by other people besides Warren Buffett. However, they are people that Warren Buffett trusts. So that is something to keep in mind. So let's take a look at TMC and do a little analysis. Oh, wait. TSM, sorry. TSM. Taiwan Semiconductor Manufacturing. Now, guys, 52-week high just a year ago, a couple days ago, 145. 52-week low recently at 59 bucks. It's now back at $86. So it's down 35%, but it was down pretty low back in November. Whew, pretty low. A couple of things I like about it. First off, market cap, enterprise value. The difference here is net cash and debt. So they only have net $19 billion in debt here. Awesome. Very low debt company. 1 year PE of 14.5. I want you guys to remember, don't just focus on 1 year PEs. The semiconductor business has been skyrocketing, and you'll see in the income statement, I haven't even looked at it yet. I can assure you that the numbers look very different in the last year or two than they did in previous years. Probably a very large jump. The question is that a permanent level? Or we can go back to normal levels? That's the question. Dividends, 2.2%, not bad. Here's the issue, $9.4 billion paid. Last year, they did $17 billion in free cash flow, but in the last 5 years, their average was 9.8. So again, the question is, are we at a new high, or are we gonna go back to our normal levels? Very high, 5-year return on invested capital, 16.3%. Love it, love it. So there's a lot of things here that are positives, but also things to think about. So let's go look at that income statement like I said. Look at this jump. Go back a few years, 31, 33, 34, 42, 49, 68. This was the whole big boom in semiconductors. Shortage of semiconductors, prices were higher. What is the gross margin on this company? Gross margin, wow, 57%. That means for every dollar they sell extra, they get 57 cents that they can use to pay for overhead and income taxes. 57 cents of it. That is huge. Comparatively, Microsoft 68%, and that's a software business that has no actual hardware costs. And a bottom line profit margin. Look at these numbers, 38% over the last 5 years. So, guys, I love high margin businesses. I love them. Every investor does. Because if you can get a high margin business with a high return on invested capital, home run city. You should pay a premium for a company like Taiwan Semiconductor. These metrics right here give a justification for paying a premium. The question is, how much of a premium? What is going to happen out there in the market is somebody hears that and thinks, oh my God, I got to pay a premium. Let me just buy it. No. Every investment's still the present value of all future cash flow. It is still very possible to overpay for a good thing. In fact, it's very common. It's very common to overpay for a good thing, and that's the problem we have in investing. Oh, semiconductors are great. Let me just go buy a semiconductor company. I was with some family this weekend, and one of the kids said, oh yeah, legalized gambling in Ohio now. I'm going to go buy Penn Gaming. I said, why? He goes, well, because it's going to keep growing up. It's like, why is that? He goes, you don't think so? I'm like, well, I don't know. I really don't have a clue. All I know is he just heard gaming was legal, therefore let me buy a gaming company. By the way, smart kid. I like the fact that he even thought that way to have the conversation and even asked the question, oh, why? I like that he asked that. So anyhow, back to our conversation on Taiwan Semiconductor. Let's go check out the 8 pillars here. All right, like usual, here's what I don't like. When the ratio is lower, when the earnings ratio is lower than the free cash flow ratio, it actually means that they're showing higher earnings than free cash flow. So let's go see what their average earnings are. So on the income statement, we scroll down our software and we provide you with the 5-year average of $17.34 billion in net income. And for cash flow, the average is 9.83. Why such a big difference? I don't like seeing that. That's kind of a red flag to me. Why are they reporting such a high earnings and low free cash flow? I don't like that at all. In fact, for me, that might be a reason I already ignore it unless the free cash flow can justify the current valuation. That's the only reason I would be fine with that. But here, based on what I see on the 8 pillars, it's hard to justify 43 price to free cash flow in a business that's cyclical and probably at the tail end of their very very good economic growth cycle. We're not here I don't think we're at the point now where we're coming off of a really bad worldwide recession. If anything, we're about ready to start one. So what's going to happen to luxury good markets that these things go into? Now, a lot of these companies put into smaller items, but the PCs, things like that, you're already starting to see a slowdown. So I'd be very cautious here. What are analysts saying? Well, they're probably not paying much attention to the slowdowns. So they're currently making, now this is in a different currency. This isn't in US dollars, but I want you to focus on growth. So there's not much growth in earnings per share, and there's not much growth in revenue. So why have such a high PE and price of free cash flow? Immediately, I think to myself, pass. But I want to teach you, because I want to teach you how to fish, how to value the company using our software. So we have our stock analyzer tool. And as you know, our stock analyzer tool is a tool that's been used over 1.3 million times just in the last 365 days. It's very popular in our community. People share the screen. They take screenshots and share it all the time. Here is where we could sit there and make our revenue growth assumptions, profit margin assumptions, and then decide what to pay for a company, because every investment is the present value of all future cash flow. And since we don't know the future cash flow, we have to make assumptions about it. But look at these differences right here. Profit margin and free cash flow margin. Look how different they are. 10 years, 5 years, and 1 year. This really bothers me. Because whenever, I always think fraud when I say, I'm not saying there's a fraud here. Please don't take it as that. But I look at it and going, man, unless they're spending a lot of money on growth, which very well could be. Let's go see their capital, their cash flow. Remember, cash flow is cash from operations less your capital expenditure. And look at this. This explains it. I love it. 8.8, 13.4, 20, 23, 32.5. They really increased their capital expenditures. This helps explain the problem. Boom. Just look at that. So I'm glad I didn't jump to the conclusion of ignoring it. That's why we have this data here. This is why I'm teaching you how to fish. Because I looked here and said, this capital expenditures are not expensed immediately. It takes years to expense these. That's why earnings will show higher. And there should be a time when they stop spending as much on, when they stabilize this, because look at the capital expenditure in previous years. 9, 10, 7.5, 10, 12. 9, 13.5, 20, 23, 33. That's big jumps. There'll be a time when that evens itself out. So let's proceed on. Let's go to the stock analyzer tool again, do a 20-year analysis. Now, the issue with this 20-year analysis is we have to assume revenue is not going to fall from here. Will it fall from here? Well, let's go to the income statement and see how it's done quarter to quarter. And this is what I like about what we're doing here, guys. I want you guys to see my thought process because I really want you to understand how I view these companies. September quarter, they did 20.2. The previous September, 13.65. That's a big jump. June, 17.6, 12.3. For the June of the previous year. All right, so we're waiting for the fourth quarter to report. That'll be a pretty big indication of, are they still revenue growing or are they going back to a more stable level? That'll be one of the times I actually do focus on their report and their earnings. So back to the stock analyzer tool. Now for revenue growth. This is where it's tricky. We have to make our assumptions here. 20 years. I'm going to be conservative and call it 5, 9, and 13. Profit margin. Let's assume things go poorly. 32, 35, 38. Free cash flow margin. I'm actually going to go higher on these ones because I think it'll equate out over time. Let's go with 23, 26, 29. PE. Now, guys, the current PE is 15.5, but it's based on a really high profit margin they haven't seen. However, over long periods of time, the average in the market is 15 PE. Should you pay more for that for fast-growing companies with a high return on invested capital? 100% you should pay more for that. The question is how much more. So on the low side, I'm going to go 15, 16.5, 18. I'm going to do 16, 17.5, and 19 on price of free cash flow because of the discrepancy between the two. I want to kind of equate it out. And you'll start to see in my underwriting, in my numbers, why I do that. Now for desired annual return, I think I'm being very conservative on the low side. However, I have to account for a drop in the revenue, potentially to start. So I'm going to go with 11, 13, and 15%. Hit the analyze button. I have it on my watch list at $60, as I said right here. This means that when it hits 60, our software is going to send me a notification on email, on my phone through the app, as well as on the software here on my desktop. And it'll tell me, Paul, Taiwan Semiconductors has hit $60 a share. Go do whatever you're going to do. This is not my time to buy. And you shouldn't buy it at 60 just because I have it on my watch list at 60. I am sitting there saying, start selling puts on it below 60. What price? I don't know. But don't take these things as go out and buy. Learn the process. So what's our value here? Whoa! Surprised to see this. 50 to 70. If you believe all my high numbers, do your research. This might be a buy today. And somewhere in the middle of 80 to 100. Now, I think I know why I put 60 in here. Even though it's a very low end of the list, I do worry about the next few years. There's a lot of shakeup happening there. I don't know what's going to occur, and I want to have more margin of safety here on this company. So if you like this, guys, need you to do me a favor. Subscribe to the channel. It's a great place to learn how to invest. And secondly, if you like our software, there's so much more to the software than what you saw today. It's all available for less than a cup of coffee. Go to everythingmoney.com. We have a no-risk money-back guarantee for the next 30 days. Thank you very much for your time. Take care.